Well, hello, everybody. We have members joining us from right across Australia. So, good morning or good afternoon, wherever you're based, and a very warm welcome to our first co-branded webinar showcasing our 2025 investor report. Now, we have only got 30 minutes together today, and we do have a lot to cover. So we'll get underway in a couple of minutes. I just want to give people the opportunity to join, but we will get going shortly. Okay, well, we might get underway. My name is Alice Piper. I'm REA Group's native content editor and podcast lead, the creator and host of all of realestate.com.au's podcasts. I'm going to be your moderator for today. I do have a couple of quick formalities before we begin. We are recording this webinar, so you can rewatch or revisit any of today's insights in your own time. And please pop any questions that you have into the little chat box. It should be at the bottom of your screen. We're going to cover as many as we possibly can during our Q&A session at the end. Onto our agenda. First, we have Andy Ashurst from Terri Scheer. Now, he's going to be sharing more about our partnership together with REA Group. And then Angus Moore from REA, who he's going to walk us through the key findings from the investor report, including who our investors are, what's happening in the market and the outlook ahead. Now, that is going to be followed by that short Q&A segment. So let's get started. Andy, I'll hand it over to you.
Yeah, thank you, Alice, and good afternoon, everyone, and a very warm welcome to today's webinar. As Alice introduced, I'm Andy Ashurst, National Key Account Manager at Terri Scheer, and I'm delighted to be here with you and the REA Group to unpack the latest PropTrack investor report and also what it means for landlords, investors, and property managers across Australia. So I hope you're probably wondering why the report matters to us at Terri Scheer. Well, at Terri Scheer, we're keen to be part of this conversation because we know just how complex the environment is for landlords and property managers right now. Rising costs, changing tenant expectations, and ongoing legislative changes are all part of the landscape. That's why we believe insurance has never been more important, not just as a safety net, but as a source of clarity, knowledge, and help in protecting investment properties in these changing times. So what's been Terri Scheer's involvement and partnership with this report? So our involvement in this report isn't just about risk management. It's about helping agents and landlords understand where the market is heading and what practical steps you can take to safeguard your portfolios. By supporting REA and leveraging their unique data and insights, we're able to provide you with a resource that's both timely and relevant. So why is the report so valuable for you as agents? So this report we see is extremely valuable, and we're confident that the investor report will offer great insights and confirm what many of you are seeing play out every day with your clients, whether you're working with seasoned investors or those just starting out. The report also highlights who today's investors are, how their profile is changing, current market activity, and where the best opportunities are across the country. It's designed to help you as agents have more informed conversations with your clients and support them in making smart, confident decisions. Thank you again for joining us. We're really excited to share these insights and support you as you navigate the evolving property landscape. With that, I'll hand over to Angus to dive into the report findings.
Thank you, Andy. Wonderful welcome and hello all. My name's Angus. I'm Executive Manager for Economics at REA Group, and I will be discussed, running through some of the highlights from our investors report that we put out with Terri Scheer. To just kind of underscore that, today I'm going to talk for about 10-15 minutes. So it is going to be very high level. It's a very detailed report, as you can see from this lovely little cascade tile that I put together here of the report. If anything that I talk about today is of interest, I encourage you to go along, read the report. You can find it on realestate.com.au/insights. There's lots of really interesting information in there and far more detailed than I'll be able to cover today. With that, what am I going to cover today? Well, as kind of already discussed, I'm going to start with a really high level picture of who it actually is typically that invests in property in Australia, and importantly, how that's kind of changed over recent decades. I'm then going to talk perhaps more relevant to our day-to-day and what we do, what we're actually seeing in terms of conditions at the market, at the moment in the market, both in terms of what investors are doing, but also what conditions are like for investors and prospective investors. And then I'll finish up with a little brief outlook in terms of what we might expect over the next 12 to 18 months. So let's start with that first point. Who actually are investors? And I'll start with perhaps the most uncontroversial chart I'll ever produce, which is this one here. Investors are typically higher income than the average Australian. So what this chart here shows is the share of people that invest in property by whether they are in the top income fifth on the right, the bottom income fifth on the left, and then in the middle. What you can see is that just shy of 30% of that top income fifth, so the highest income 20% of Australians invest in property, versus only around about 5% of that lowest income fifth. Unsurprising. This is for two reasons. One, obviously, investing in property means servicing a mortgage. It is much easier to do that when you are higher income, particularly if it is a second mortgage on top of your owner-occupied property. We would expect that to skew higher income. It also skews higher income to some extent because the benefits from negative gearing accrue more at those higher income levels where you're paying higher marginal tax rates, and therefore the deductions have more of an impact on your taxable, the amount of tax you have to pay. So both of these facts, unsurprising. Perhaps equally unsurprising, though, as we'll talk about in a moment, starting to change, is how old investors are. And they are typically in those sort of peak earning years of the career, from 35 through to 64. You can see that on this chart here. Those age groups, skewing a little bit to the older side, but those age groups, around about 1 in 5 of them invest in property. Whereas for younger, particularly much younger, and for older, importantly, as we'll talk about in a moment, it is much less common. You can see it drops right off for 65 and older and way down for 75 and older. So those that are post-retirement are much less likely to invest in property, more or less for the reasons that we just spoke about. Obviously, servicing a mortgage requires income, hard if you're retired, and equally, the benefits from negative gearing, those deductions, don't make a lot of sense if you're no longer employed and don't have employee income to deduct those against. So again, we see that skew towards those sort of high income peak earning years. So I've spoken a lot about, this sort of characteristics, but actually maybe the question that is more elementary here is actually how many people invest. How common is it? And the answer is it's about 15% of Australians that invest in property. Now, this data is the best data we have on this. It comes from the tax office, from tax returns. So what this is saying is roughly 15% of people report earning gross rental income on their tax return. It is quite delayed. The most recent data we have here is for the 23 financial year, because we need people to fill in their tax returns and then we need the tax office to actually publish those data. So we don't get very timely data from here. But an interesting thing that you can see is that actually over the past decade or so, that share has been pretty stable and even declined a little bit towards the end of this period. Now, this is quite delayed. We're talking 2 years ago at this point, and things have changed a lot since then, as we'll talk about in a moment. But through the pandemic, we did see a lot of people selling their investment properties, not a lot of investors buying in at the time. And so this is maybe not surprising. It is worth also underscoring, though, that this is a big change from how Australia's rental market and property market used to look if we go back 4 decades. Back 4 decades ago, it's only around 4.5% of people that invested in a rental property. And that has continually increased up until its peak in about the mid-2010s and has been fairly stable since then. The other big change we've seen in the investor landscape is that investors are getting a lot older. So this chart here is showing of all investors, what share of them are within these age groups. Now, the ones on the right are fairly uninteresting, and we'll largely skip over those. It's the two on the left that I want to talk about most. What we've seen is a decline in the share of people under 40 investing in property from about a third in the 2000s to less than a quarter today, and a commensurate increase in those aged over 60 investing in property. So from about 15% in the early 2000s to more than a quarter today. So more than a quarter of investors today are 60 and older. That's a big change, and it reflects kind of two big trends that we're seeing, and they're very related trends. One is this looks a bit like the age distribution of the population overall. The population is getting older. There are more people aged over 60 than there used to be, fewer aged under 40 as a share, at least, not in absolute terms. And so we'd expect this to just kind of reflect that. But it also reflects later retirement and the fact that people are working longer and participating in the labour force later in life. And so that cliff that we talked about of people retiring and therefore becoming less attractive to own an investment property is getting later and later. And that's why we're starting to see more and more over 60s continuing to hold on to their rental properties. All right, I'm going to leave the past and the big trends behind and talk about what we're actually seeing at the moment and what conditions look like for investors. And I think the best place to start is just what are we actually seeing from investors? And the short answer is a lot. This chart here shows the number of loans issued to investors. It's the best proxy we have for purchases by investors because most investors are going to be buying with a loan. Some won't, but it's sort of the best proxy that we have. What you can see is that the pandemic was obviously very busy. That was true for all buyer types. We then see a decline in activity as the RBA starts to raise rates. Again, true for all buyer types. But then over the past 2 years, we've seen a pretty steady and pretty significant increase in investor activity, despite very high mortgage rates. And this is actually in contrast to what we're seeing from other buyer types who really haven't seen that much of a pickup. What that means, kind of practically, is that surge in investor activity, coupled with the fact that other buyers haven't been as active, means the share of new loans going to investors, or equivalently, the share of buyers in the market that are investors, is near record levels in many states at the moment. So on the right, I've got WA and Queensland. You can see circa 40% of loans, a little bit under in more recent data, but circa 40% of loans are going to investors at the moment, as high as we've ever seen in those states. It's not a record, but it's very, very close. South Australia looks exactly the same as these. Putting it on would just make the lines harder to read. New South Wales, similarly, 45% of loans going to investors, high level relative to history, highest we've seen since 2017. Victoria stands out. It's the only state where we haven't seen a big pickup in investor activity. Given we're sort of going through it quickly here, I won't talk too much to that state-specific stuff, but something we can pick up in the Q&A if it's of interest. But we just haven't seen as much of an increase in investors there, and so it's still lagging behind what we're seeing in other states. So why? Why are we seeing such a big pickup in investor activity? And I think the answer is simply summarized as rental markets are incredibly tight, and that's very attractive to investors. So to unpack what that looks like in practice a little bit more, the chart on the left is my kind of favorite measure of the rental market broadly, which is the rental vacancy rate. So that's just the number of rentals that you could move into today as a share of the total number of rentals. Doesn't matter where you look across the country at the moment, it is incredibly low. We're talking circa 1 to 1.5% in pretty much all capital cities at the moment. And that's much lower than what we would consider normal, which is sort of more like 2 to 2.5%, which you can see kind of pre-pandemic there. The good news for renters is that this has improved a little bit in the last sort of 2 years. It is obviously very volatile month to month because it depends on seasonal factors and people moving in and out of rentals. But the broad trend has been a little bit of an easing in availability, though I would really stress a little bit. You have to squint a little bit to see that improvement, and conditions do remain very, very challenging for renters. It is still very hard to find a rental. And that's manifesting on the right, which is just showing median advertised rents for capital cities on the left and regional areas on the right. Simple answer here is just line goes up. We have seen an enormous increase in rents over recent years. And again, this has not been just 1 or 2 cities. This has been everywhere around the country, to greater or lesser extents, but everywhere has seen big increases in rents. And so that combination of very tight rental markets, fast leasing times, low risks of not being able to find a tenant, as well as rapidly increasing and substantially higher rents than was true 5 years ago, is probably attractive to a lot of investors and is part of what we're seeing supporting investor activity. The fact that the RBA's cut rates a few times probably hasn't hurt either, though that's maybe looking a little less promising this week than it was perhaps 2 or 3 weeks ago. The other thing that we're seeing from investors, to take a little bit of a left turn, is that most recent sales by investors, so looking at the other side, we've been talking about buying in, this is talking about investors selling out, most of them have made a profit on that resale. So the chart on the left is just showing the share of investor sales by each month, what share of them sold for more than they bought. It's as high as we've ever seen on our records. More than 90% of sales are for more than they were purchased for. And on the right, you can see kind of why that is. It's coming from Brisbane, Adelaide and Perth, where effectively every resale by an investor has been profitable. It's really only Melbourne where we've seen any appreciable number of loss-making sales. And the reason for that is this chart here, which is showing the change in home prices relative to the start of the pandemic, so March 2020. And you can see on the right for Brisbane, Adelaide and Perth, why pretty much anyone that's bought at any point in the last 5 years has sold at a profit. If you bought in 2020 and sold today, prices have on average doubled in those cities. So it is fairly hard to have sold for less than you bought unless you bought very recently and sold very quickly. The same is not true for Melbourne. If you look at the left there, you can see Melbourne in the purple. Prices have largely tracked sideways since the RBA started raising rates in early 2022. And it was only in September this year, 2 months ago, the prices actually reached back to that point. So investors that bought sort of through that period and resold on a relatively short time frame potentially are looking at, on average, having made a loss. Now, of course, many investors will have held for a lot longer than that, benefited from the boom that we saw during the pandemic. Melbourne still saw that boom during the pandemic, so most are still selling for a profit, but some for a loss there. Right. Let's wrap up and then we'll throw open to Q&A. As I sort of hinted to before, things are maybe looking a little less rosy on mortgage rates than they had been, but it is important to take a step back and look at where we're at relative to where we've been. Mortgage rates today are obviously much, much higher than they have been throughout the 2010s and certainly through the pandemic when they were at record lows. But the good news is today, they are still quite a lot lower than they were at peak a year or two ago. And that is helping support buyer activity, not just investors, all buyers, and also supporting home prices. It's a big part of why Melbourne has started to see a recovery this year. It's the fact that we've seen those few rate cuts. At the moment, market pricing, which you can see in that little dotted line there, implies we'll probably get one more rate cut by sort of mid next year. That is less optimistic than we were, a couple of weeks ago. The reason for that is inflation in September came in quite a lot higher than the RBA had forecast, than kind of was widely expected. And the RBA has shifted up their expectations for inflation as a result. And that means we're just not as likely to see rate cuts. It unfortunately doesn't look like inflation is as much of a solved problem as we perhaps thought it was. So we're now looking at hopefully one cut next year, potentially maybe not, depending on what inflation does. But we're unlikely to see the two that we were expecting a few weeks ago. Even so, that sort of maybe slightly dour news aside, investors are likely to remain pretty active over the next 12 to 18 months. And the reasons for that come down to why they're active at the moment. Rental markets, while they've eased a little bit and while rent growth has slowed down a little bit, rental markets remain very, very tight. Rents are still growing very quickly. Vacancy rates are still low. Rentals are still leasing very quickly. So that picture of quite attractive rental market conditions for investors remains true and will, I think, continue to entice many to look into the market. So I would expect to continue to see pretty strong investor activity over the next 12 to 18 months. With that, I will wrap up, hand back to Alice, and throw open to questions. But thank you very much for your time, everyone.
Angus, thank you so much. That was such an informative session with so much rich data. As Angus said, I'm now going to open up to the Q&A session. So definitely get your questions in. I'm actually going to kick it off, though, with a question that I have for Andy. Andy, how does the PropTrack Investor Report help real estate agents and advise landlords on risk management?
Yeah, thanks, Alice. I suppose the report provides agents with up-to-date insights into the conditions, the market conditions. Also, obviously highlights investor behavior, emerging risks. And we feel by understanding these trends, like rising costs, change in tenant expectations, and legislative updates, which has been pretty profound around the country, agents, we feel, can more confidently provide information on their risks their clients may face. Obviously, with Terri Scheer, our products are designed to address these risks, helping landlords protect their investment and making more informed decisions.
I've got another question here. So why is landlords insurance more important now than ever, according to the report's findings?
Yeah, so obviously with the report tracking back to that, it shows government policy, regulations, taxes are obviously key considerations for investors looking at purchasing a rental property. These differ obviously state to state, and so are too numerous to cover here. But notable recent changes, including obviously bans on rent bidding during applications, limits on how frequently rents can be increased, eliminating no ground evictions, and sadly in Victoria, increases in land and tax for investors. Obviously, this may infer that landlords are facing a more complex environment. So we see insurance isn't just about risk management, it's more about providing clarity and confidence. And Terri Scheer's covers helps landlords and agents navigate uncertainty and hopefully ensuring investment properties are protected against these challenges highlighted in Angus's report.
Okay, wonderful. Well, I've actually had a question come in for Angus. Angus, at the start of your presentation, you showed that the share of people investing in property has fallen. So why is that? And is that going to continue?
Yeah, it's an interesting trend that we saw there. I think the short answer is what we saw there was a little bit an artifact of the time period we're talking about there, which, that's 2022, 23 tax returns, which is kind of immediately post the pandemic and, as the RBA starts raising rates. That was actually quite an unattractive time for investors. Winding back to 2020, 2021, it's maybe hard to remember now, particularly in an environment in which we're talking about how tight rental markets are. But in our largest rental markets, in Sydney, in Melbourne, rents fell. Vacancy rates were quite high, but home prices were up and up quite strongly. And so what we saw at the time was quite a lot of investors looking to sell out and doing so, and not as many buying in as perhaps was the case today. What that meant is we saw a bit of a fall in the number of investors as a share of the population. And that kind of was commensurate with a big increase in the number of first home buyers that we saw because of very, very low rates enabling many to get in. That's changed in recent years, but the sort of activity that we were talking about, that big pickup in investor activity, all postdates that data that we have there from tax returns for FY23. So I'd expect that to have turned around in the last year or two, as we've seen a lot of investors buying in, as we're probably not seeing as many sell out because rental market conditions are a lot stronger, and we're sort of past that pandemic period. But we just don't know yet. We'll find out once everyone does their tax returns, which I hope they have, because it is November now, and your tax returns were due last week. And once the ATO report on them, but that's still a couple of years away, unfortunately.
Well, I've had another question come in for you, Angus, and it's a topic that we are hearing more and more about. But this person wants to know, how common is rent vesting for first home buyers?
Yeah, it's a great question, and it's a really interesting area. Certainly I know a few people anecdotally doing it. The short answer is, if we look at the data, it's not particularly common. The share of first home buyers that are investors as opposed to owner occupiers is fairly stable around the sort of mid-single digits. So, somewhere between 5 and 7%, depending on when you're looking. So it certainly exists, but it's not especially common. It's a little bit more common in New South Wales than it is in, say, Victoria, which again is sort of consistent with the fact that, Sydney is a very expensive market. It's maybe more attractive to take that rent vesting strategy than in Victoria, where, while home prices are a lot higher than they used to be, affordability is a lot better than it is in somewhere like Sydney. And so for first home buyers, owner occupation is perhaps more viable than in Sydney.
Okay, well, Andy, I've had a question come in for you. Why is having a trusted insurance partner so important for agencies managing investor relationships?
Yeah, I'll start with your short answer to that, Alice. Obviously, agents having a trusted insurance provider like Terri Scheer we see as invaluable, especially in today's market. It means you can offer your investor clients expert guidance on how to reduce risk and responsive support when things sadly do go wrong. The PropTrack investor report, it shows that the market is dynamic and risks are evolving constantly. So having a provider who understands these changes and can provide practical solutions, we hope helps agencies build those stronger relationships, delivering better service and ultimately supporting their clients' long-term success in the market.
Okay, I'm just going through the questions. Angus, we've got one for you. Where are we seeing the most investor activity at the moment? And we've got about 4 minutes left. So
I reckon
do your quickest.
do it even quicker.
Yeah.
Perhaps unsurprisingly, if we look at where investors are buying, it is concentrated in the sorts of areas that have big, deep, liquid rental markets. Think inner city Melbourne, inner city Sydney, inner city Brisbane. Those are big, popular rental markets. We see a lot of investors buying there. Perhaps the more interesting answer, though, where we see that maybe not as obvious, where we're seeing a lot of investor activity at the moment, is actually the more affordable parts of our cities. Think Ipswich in Brisbane or St Mary's in Sydney. These represent a bit more affordable entry point, and while they're not as big rental markets as the inner city, they are still really quite popular with investors at the moment.
Okay, well, my very last question is for you, Andy.
Mm.
What are the most common insurance claims that Terri Scheer sees from landlords, and how does this relate to what we found in the report?
So obviously with our most frequent claims, we see for loss of rent, tenant damage and escape of liquids like water damage to carpets, etc. The report highlights how tight rental markets are changing, obviously these tenant dynamics, and these risks may shift quite considerably. Despite recent declines in interest rates, a high percentage of rental income goes to covering the mortgage. So we feel insurance may help to manage the cost in the event of a claim, providing peace of mind. By sharing these insights as well, which Angus has discussed, we hope will help agents and landlords understand the real world challenges out there and the value of having tailored insurance to safeguard their properties.
Okay, well, thank you so much, both of you, for your time. It's been a really informative session. We might wrap up here, I think. But before everybody jumps off, we are going to have a little poll pop up on your screen. And what that's going to do is provide us with some really valuable feedback on how you guys found today's session. So I want to thank you all for your time. And as I mentioned earlier, this has been recorded, so you are more than welcome to revisit these insights at any time.